Hi, welcome to another session of Kurga Tariq Finance and Accountancy Tutorials. Today, as promised earlier, we are going to look at a question, a practical example that was examined by Kasneb on May 2021 on Accounting Technician Diploma Level 1. So this is question 4. Before we continue, if you are not subscribed to this channel, please consider doing that. And if you are returning subscribers, welcome so much. So please also share, you like, let others know that there is a channel here in YouTube that teaches us for free. Make sure you also hit the notification bell so that whenever I upload a new video, you will get it right in your devices. So let's move straight to our question today. So the question reads that Bondo, Chilungu and Donde are in partnership sharing profits and losses in the ratio of 3:1. The trial balance of partnership as of that 1st October 2020 was as follows. So you have the capital accounts for Bondo, Chilungu and Donde, current accounts 2 for Bondo, Chilungu and Donde, the allowance for doubtful debts through to drawings of Bondo, Chilungu and Donde. So the additional information, we are told, number 1, inventory as at 31st October 2020 was shillings 450 million. Then number 2, the non-current assets are to be depreciated on cost at the following rates. Buildings at 5% per annum, motor vehicles at 20% per annum. Then number 3, rates prepaid on 31st October 2020 amount to 30 million. On October 31st, 2020, an amount of 26,625,000 was owing in respect of selling expenses. And then a debt of 7,500,000 is to be written off. Then number 6, allowance for doubtful debts is to be adjusted to 5% of outstanding debtors as at 31st October 2020. Number 7, the partnership agreement provides that Donde is to be allowed a salary of 90 million per annum. Then 10% interest per annum is to be allowed on capital account balances, and then no interest is allowed on current accounts and no interest is charged on drawings. So you are required to A, statement of profit and loss and appropriation account for the year ended at 1st October 2020, the partner's current accounts as at 31st October 2020, and statement of financial position as at 31st October 2020. I want to believe that at the end of this question you'll have understood what we are doing in our part 1 and part 2 of the partnership accounts. So without much ado, let's go straight to how we are going to handle this. So when given such kind of a question, ladies and gentlemen, please ensure that you start with the workings. Workings are in the additional information. We said when we were introducing the trial balances that the information in the trial balances, everything that is in the trial balance has gone through the double entry rule of accounting. But the additional information you need to adjust so that to make sure that it also obeys or it is also compliant to the double entry rule of accounting. That is, you adjust with the balances already in the trial balance. So let's start with the additional information. It's very important that you start with the workings. So let's start with the workings. Workings. So working number 1, inventory, there is no working there. So what you're going to work is number 2, the non-current assets are to be depreciation. So we have working number 1 is depreciation. And then you have buildings is 5% per annum. So remember, they are being depreciated on cost. And remember, when you are talking about depreciations, we say that depreciations are either reducing balance or on cost or other any form or method of depreciation. But when we say the depreciation is on cost, it means that this is straight line method of depreciation, right? And then for reducing balance method, another name is declining method. So we're going to multiply 5% straight with the on cost of buildings, which is 900,000. And then for motor vehicles is 20% per annum still on cost. The cost of motor vehicles in this case is 300,000, right? Which is 45,000. Then for the other one is, this other one is 60,000. 60,000. Then our working number 2 is all about rates prepaid. So what you're going to do is that you're going to write what the trial balance is saying. So you have rent and rates. Rent and rates. Remember, these are combined. So the rent and rates in the trial balance, the balance brought down in the trial balance for rent and rates is 60,000. Then we are told that the rates have been prepaid by 30,000 Kenya shillings. Prepaid means they were paid in advance. And remember, in our accrual method of accounting, the accrual basis of accounting, expenses are recognized when they have been incurred and not when they have been paid. So the incurred amount of expenses here is a value less 60,000 because this figure of 60,000 has been prepaid. So meaning we are going to reduce this one so that we see how much the partnership business really incurred. So you say you less prepaid. And you know where this prepaid will go? It will go to the balance sheet as an asset, right? It will go as an asset. Remember, this is credit side, this is debit. So since this is credit side, it will go to the balance sheet on the debit side. Debit side has some elements like assets, and that is why to complete the double entry, this credit to go to the balance sheet on the debit side as a current asset. You'll have prepaid rates of 30,000. So you see, we will have completed the double entry. This is credit and this one is debit, right? Okay, so 30,000. So to close this account, you double 2 lines, and then the side that is heavier than the other one is this one. So meaning the balance carried down is here. So meaning our balance brought down will come here as 30,000. Our next working is working number 3. Working number 3, that we are told that on 31st October 2020, an amount of 26,625,000 was owing in respect of selling expenses. So meaning selling expenses, we are going to open selling expenses account. So the balance brought down from the trial balance, selling expenses is 210,000. But you are told this figure of 210,000 is less, right? So the partnership business need to pay an extra 26,625, right? So that is what they incurred. They incurred a figure more than this one, but they paid 210, meaning they still have to add this owing, right? This owing. Accrual basis of accounting. So you add accruals. You add accrual of 26,625. 26,625. Meaning our balance carried down to 36 625, 236, 625, 236, 625, meaning our balance brought down will be here of 236, 625, right? So this is the figure that you are going to take to the income statement as the amount of selling and expenses. This is what was actually incurred, not 210. That is what the accrual basis of accounting tries to tell us. So then number 5 is that a debt of 7,500,000 is to be written off. So that one is the bad debt. I want to believe you remember when we said when the bad debts are outside the trial balance, then you are going to reduce the figure of the debtors that are in the trial balance or the receivables before you provide for bad and doubtful debts. And then next we are told the allowance for doubtful debts is to be adjusted to 5% of the outstanding debtors. Meaning after we have reduced 7,500,000, the figure of bad debts from the figure of receivables or the trade receivables in the trial balance, then the resultant or the outstanding debtors is subject to 5% provision. So that is our working number for provision for bad and doubtful debts. Provisions for bad and doubtful debts. This is what to do. So before we calculate for the provision, we have to find net receivables or net debtors. So you are going to say provided in the trial balance. What is in the trial balance? Balance brought down. In the trial balance for the receivables is 345,000. Yes, and then we less bad debts. Bad debts here are 7,500,000. Sorry, remember we are going to subject it to thousands. So this is the figure of net debtors. These are net debtors or the outstanding debtors. And now we now provide for bad and doubtful debts. But this is the way to go. You say the previous provision. The previous provision is the trial balance. That is the allowance for bad and doubtful debts as at 1st November 2019 was 15,000. It was 15,000. And then the current provision is they are providing at 5% of outstanding debtors. 5% of outstanding debtors is 33,750. The figure is 16,875 less. So the resultant figure means, okay, remember when we were discussing about the provision for bad doubtful debts, the link I have attached here under in the comment section. Please you rewind as many times as possible so that you understand the issue of provisions. We said that for provisions, you compare the provisions for the two provisions. The provision provided in the trial balance and the provision for the year that is provided or given in the additional information. So you check if there is an increase in provision, then automatically there is an expense. But if there is a decrease, then it is an income, and you know how to treat in the income statement. So for this case, previous was 15,000, but current is 16,000, meaning there was an increase in provision. That increase in provision is an expense and will be taken, or rather will be treated as an expense in the income statement. So the figure is 1875. This one is increase in provision. Increase in provision. So this one, you're going to take this figure to the income statement as an expense. This one you take it as an expense. Are you together? So that is how to go about the workings. Now that we are done with the workings, we can now comfortably open the income statement so that we can determine the net profit or the net loss that will be shared by the partners according to their profit sharing ratio. But before they share that profit or loss, then we'll have to open a trading profit and appropriation account so that we adjust with some items there, and then the resultant or the residual profit or loss will be shared thereafter accordingly, according to their profit sharing ratio. So ladies and gentlemen, we are going to open an income statement. So now that we have Bondo, Chilungu and Donde, I'm going to denote Bondo with B, and then Chilungu with C, and then Donde with D. Yes, so we have Bondo, Chilungu and Donde partnership. So the income statement starts with sales. Sales. So the sales figure from our question is 2,250,000. 2,250,000. And then we are supposed to less return inwards. But from the question, I cannot see the return inwards anywhere. So we are going to say less cost of sales. Cost of sales. Now, cost of sales starts with the opening stock, obvious. Opening stock you put in the second column. So we have the stock as at, or inventory as at 1st November 2019 being 300,000. Then this opening stock we add purchases. But before we write purchases here on this column where the opening stock is, then we have to see if we have some other adjustments of purchases. So the adjustments of purchase will involve the carriage inwards. If there is, we add. From the question you don't have. If we have returns on purchases, then we adjust by reducing the purchase figure. And then if we have standalone wages, you also add to the cost of sales. Now that we don't have any other adjustment for purchases, we are going to take the purchase figure directly that other side. So the purchase figure is 1,275,000. 1,275,000. Yes, and then we less closing stock. Closing stock is the enclosing inventory, and the closing inventory will be found in the additional information and not in the trial balance. So we are told in the additional information that number 1, that the inventory as at 1st October 2020 was 450 million. So 450 million, but in our case 450,000 because the column itself is in thousands. So but you less. So you're going to less. So the figure you're going to get is the gross profit. So our gross profit is the difference, which is 1,125,000. So as a matter of procedure, as a matter of the format, when you find the gross profit, you have to add other incomes. But in our case, I don't see any income, so you go directly to less. You less the expenses stroke losses. You less expenses stroke losses. So, ladies and gentlemen, before you go to the trial balance looking for these expenses, it is advisable that you start with the workings that we had done. The main reason we are doing the workings before is so that we transfer the correct figures here into the expenses and losses, and also others will go to the balance sheet. So the working number 1 was on depreciation. And the depreciation, we had buildings. And then we also had motor vehicles. So the depreciation for buildings was 45,000. Then for motor vehicle was 60,000. Right? You can refer. So and then the working number 2 was for rates prepaid. Okay, for rent and rates. Yes, you can go back to our workings, you will find these figures here. And it is important to show the working reference that you did in the working so that to be easier to reference. So in this case, the working number 2 was rent and rates, and the value was 30,000. Right? And then we also had the selling expenses as our next working. Selling expenses, those were the selling expenses. And then we had the bad debts that were written off of 7,500, right? Then we had the allowance for doubtful debts adjustment, right? So that was our working. I don't know if it's working number 4, allowance, or okay, in this case there was an increase in provision, right? So you're going to write increase in provision for bad debts. You can refer with your workings. Then after we are done with the working, the additional information, then we go to the debit column of our trial balance, because expenses have got debit balances. You look on the debit side if you have anything like an expense that we have not included here. So in the debit side, I can see we also had the motor vehicle expenses. The motor vehicle expenses of 20,000. Then you also had office expenses. The office expenses of 210. No, sorry. Office expenses of 40,000 Kenya shillings. So we don't have any other expense. So you're going to add all these, then we reduce from the gross profit. And the totals will be 441,000. Then we are supposed to reduce. We are supposed to less as such. So when you say the gross profit minus 441,000, the answer is 684,000, which is positive. So this is the net profit. Yes. So ladies and gentlemen, you can see this one is the end of the income statement, but it marks the beginning of the trading profit and loss appropriation account, because this is partnership, right? But for the sole trader, the whole the income statement stops at this point, because the net profits are enjoyed, or the net loss are enjoyed by one person, who is the owner, the sole trader. So our next step is to open the partnership trading profit and loss appropriation. So this is how to do. So we have B, C, and D, partnership, profit and loss, appropriation, account. That is how to write. So still you'll have our 3 currency signs, all in thousands. As such. And then I told you where the income statement stops, that is where the appropriation account picks up from. So it stopped at the net profit. So you're going to write our net profit here. Our net profit, which is 684,000. You write it in this column. Yes, I told you since it is an appropriation, we are going to add some items and then you less others, so that the residual profit is the one that is going to be shared to the partners according to the profit and loss sharing ratio. So what is going to add to the net profit is the interest on drawings. But in this case, we are told that the partnership agreement, there is no interest charged on drawings, so we don't have anything to add on this side, but we have what to less. We had the interest on capital, and here we have three partners. So B, we have B, C, and we have D. So the interest on capital is 10% of the capital bundi is 270,000. So the 10% of 270,000 is around 27,000. And then for Chilungu is 10% of the capital of Chilungu is 180,000, which is around 18,000. Then for Donde is 10% of capital of Donde is 90,000. When you multiply, you get around 9,000. So that is the interest on capital. And then again, we are supposed to less salary. Yes. So we are told that this person known as that Donde is to be allowed a salary of 90,000 per month. So Donde is the one who is earning salary. Donde is earning a salary of 90 million, which is in this case will be 90,000 because the column itself is in thousands. Then I don't think you have any other thing to less. You don't have. So you're going to add all of them. Then you transfer the balances to reduce the net profit. You less, because you said less those figures. So when you less, the figure is 540,000. So this one is the residual profit. So this profit is the one that is going to be shared by the partners according to their profit sharing ratio. So profit share is what is the next. So you're going to say less profit share. So in our case, we had Bondo, we had Chilungu, and we also had Donde. So the profit share for Bondo is, the profit sharing ratio is 3 to 2 to 1. So there's 3 over 6 times 540,000, that is for Bondo, and then 2 over 6 times 540,000 for Chilungu, and 1 over 6 times 540,000 for Donde. All should add up to 540,000. Right? So that is how to open the partnership profit and loss appropriation account. So you ladies and gentlemen, if you have a challenge in opening the profit and loss appropriation account, I have shared a link below so that it can take you back to where we were doing, or where I was giving a format of the profit and loss appropriation account, including quite a number of explanations there. So ladies and gentlemen, having this in mind, then you can comfortably again open the partnership current account, right? The partnership current account. So some items here that we have reduced are going to add the partnership current accounts, or rather the partners' current account balances, because the interest on capital is a benefit to the partner. So you're going to add to the partner's balance. And these balances, most of the cases, these are okay. A current account is a capital account. It has got credit balances, so you take these ones to the credit side, and then whatever you added here, you're going to reduce, or rather include in the debit side of the current account, but you don't have anything here that we've added. So ladies and gentlemen, let's now move to opening of the current account, because that is a requirement by the question that we open the partner's current account, and then finally the statement of financial position. So we can now open the partner's current account comfortably. So let's go. You're going to say B, C, and D current account. So ideally, the balance is brought down for the current accounts on the credit side, but you may find the balances in the question where the balances of the current account for some partners or one or two partners on the debit side. That one means the partner or the partners overdrew their accounts. That is why they have the negative balances, and negative balances means they have debit balances. But okay, in our question, we have the balances brought down. We have the balances brought down for Bondo. Bondo, for current accounts, for Bondo is on the credit, which is okay, 10,500. But for Chilungu's balance is on the debit side because it's negative. So Chilungu overdrew his account. So the balance brought down for Chilungu is 7,500 on the debit side. And then for Donde is on the other side, which is credit of 4,500 together. So here we are going to add interest on capital. Interest on capital. So our interest on capital was, we had interest on capital was 27,000 for Bondo. We had 18,000 and we had 9,000 for Bondo. Then we also had the salary. The salary for Donde. So Donde was the one who was earning salary here, and the salary was around 90,000 together. So our next thing that you're supposed to add here is the profit share. Remember, all these are benefits to the partner, and the benefits of the partner adds on their capital balances. So we had the profit share. So from the profit share, we had done the profit sharing in the profit and loss appropriation account, and the profit share for Bondo was 270,000. We had 180,000 for Chilungu and 90,000 for Bondo. And then on the debit side, I told you from our format of the current account that drawings and the interest on drawings will come on the debit side. So the drawings for Bondo is 60,000, and then we have for Chilungu is 45,000 and 45,000 also for Donde. So ladies and gentlemen, I don't think we have any other thing to include on the current account. So the next thing, or the next task that you have ahead, is to balance off this account. I told you balancing off of the current account is the same as balancing the cash book, right? So you balance one column for Bondo separately, for Chilungu separately, and for Donde separately. So you're going to do this way. So let us start with Bondo. Bondo, which side is heavier? So the credit side is heavier, 307, 500, right? So this also side must balance with 307 500, meaning we have a balance brought down on this side for Bondo of 247,500. Yes, so that is the difference between 307 500 minus 60,000. That is the figure. So let's move to Chilungu. Chilungu, the credit side also is heavier than this other side. 198,000. So this also side, the debit must balance with 198,000. So 198,000 minus 45,000, 145,500. You can confirm with your calculator. And then we go to Donde. So it looks like the credit side also is heavier than the debit side. So the totals of the credit side of Donde is, so the debit side also must balance with 193,500. So meaning the balance carried down is 148,500. You can confirm with your calculator. Now, ladies and gentlemen, since you have the balances carried down, so the balances carried down on the debit side means the balances brought down will be on the credit side as shown below. So the balance brought down for Bondo is 247,500, and then for Chilungu is 145,500, and then for Donde is 148,500. 148,500. So ladies and gentlemen, when we'll be opening the statement of financial position or the balance sheet, then these are the balances that you are going to take to the balance sheet as the finance by section. The finance by section, these are the balances of current accounts that you are going to take there. Now that is it. Now ladies and gentlemen, our next step now, our final step is to open the statement of financial position as at 31st October 2020. So we're going to just do the same way that we did. I want to believe you still remember the format of statement of financial position. The statement of financial position is the balance sheet. And we said the balance sheet is the accounting equation where assets must be equated to capital plus liabilities. So let's go. So this is BCD partnership, statement of financial position. As at 31st October 2020. Very important. So this one is a balance sheet. We start with the assets. And the assets, we have two types of assets, the non-current assets and the current assets. So you're going to start with the non-current assets. Non-current assets, so we have our currency signs here, shillings in thousand, and then shillings in thousands, and shillings in thousands. So, but for the non-current assets, we must have costs, the accumulated depreciation, and the net book values. Right? That was the format. So the non-current assets in our case are, we have the buildings. We have buildings as non-current assets. Buildings, and then buildings at cost. The buildings at cost are 900,000. Then the accumulated depreciation. We had, okay, for building we have accumulated depreciation of 180,000 plus the depreciation of this year, of the year in question, was around 45,000. So you can check the workings, our working number one. And then we also have motor vehicles. The motor vehicle at cost is 300,000. we do the same. So the motor vehicle provision or accumulated depreciation is 120,000. You add the 60,000 depreciation that we calculated, right? So I don't think we have another non-current asset. So ladies and gentlemen, this one will not further, we are not going to use it further, and also this the totals of the accumulated depreciation. But you are going to less, you say 900,000 minus the totals of accumulated depreciation, they will be the net book values, 675,000. Same case applies to motor vehicle, 120,000. Then we add the 2. The answer is 795,000. So that is the total non-current assets. That is our figure of our total non-current assets. So our next thing that you are going to include here is the current assets, because assets are divided into non-current and the current assets. So the current assets, ladies and gentlemen, listen and listen here very carefully. When you reach the point of the current assets, you first of all visit the additional information, the workings. So from the workings, there is something we had said, the accounting treatment for prepaid expenses, they are current assets. And then for accrued incomes, they are current assets, right? So in this case, I can see we had rates that were prepaid. So the rates that were prepared are assets to us. They are assets to the partnership business. So you'll say prepaid rates. Prepaid rates were 30,000 or 30 million, but in our case, 30,000. And then, ladies and gentlemen, I don't think we had any other asset that, okay, the prepaid expenses, that was the only prepaid expense. So next step is to check on the debit side of the trial balance, because assets are always on the debit side of the trial balance. So our first asset in the trial balance I can see is trade receivables. Trade receivables are assets, and we had the adjustment. So the trade receivables here are 345,000. So let me write them here. So the trade receivables are 345,000. You less the bad debts that are outside the trial balance. But if the bad debts were inside the trial balance, it means that they have already gone through the double entry rule of accounting with the trade receivables, and you're not supposed to reduce them further. But since they are outside the trial balance, then you must reduce from the figure of receivables so that to get the net trade receivables. So the figure was 7,500. But remember, we also had the provision for bad and doubtful debts for the year, not accumulated, but for this year. And the figure was 16,875. So when you less all that, you find the figure of now the net debtors that are supposed to be shown in the balance sheet. And the figure is 320,625, right? So, and then our next asset on the debit side is the bank balance. I can see the bank balance. The bank balance is, what's the figure? 37,500. Then we also have inventory, that is the closing inventory. So the closing stock should be included here, but should be, okay, the closing stock is the one that is included as current asset, in the statement of financial position. So don't be tempted to bring the inventory, that is the opening inventory, that is the inventory inside the trial balance, that is known as the opening inventory here. No, the opening inventory was adjusted in the cost of sales when we are opening the income statement, but here the closing inventory is the one that is going to be included as the current assets, and the closing inventory was 450,000. Okay, 450 million, but in our case we are dealing with thousands. So ladies and gentlemen, you don't have any other assets, so you sum all the other assets and you take them to this other side. The figure is 838,125. So when you add the two, you get 1633,125. So this is total assets. So these are the total assets. So these total assets of 1633,125 must equate to the total capital and liability. So our capital is the capital accounts for the partners and the current accounts. For the liabilities, then you have to check on the liabilities. So but let's start with liabilities. Liabilities. So we normally start with the current liabilities. Current liabilities. So in our case, you go to the additional information and confirm all the accrued expenses are liabilities, right? All the accrued expenses, and also the prepaid incomes are also liabilities. But what you have in the additional information are accrued expenses. So we have accrued expense of selling expenses. So accrued selling expenses. We had accrued selling expenses of 26,625. And you also have trade payables. Trade payables are in the trial balance. The trade payables are 525,000. Just check on the credit side if you have any other liability, and we don't have any other liability. So you add the two and you take them to this other side. The figure is 551,625, right? And then this partnership business was financed by, the business is financed by capital accounts, it's financed by capital accounts. So we have the capital account for Bondo, So the capital accounts for Bondo, we have Chilungu and Donde, right? So the capital accounts for Bondo is 270,000. You show it on this column, 270,000. You can just show it here, 270,000. We have Chilungu is 180,000, and we have 90,000 for Donde. And then this partnership also is also financed by the current accounts. We have the current accounts of Bondo, Chilungu, and Donde. So the current accounts, you come and take their balances from the current account. So for Bondo, the balance was 247,500. For Chilungu was 145,500. Then 148,500 for Donde. So this one is 145,500. Right? So the next thing is to add. So the total of capital accounts, you take them here, and then the totals of the current account on that other side. So the totals of capital accounts are 540,000, and then for the current accounts is 541,500. The next thing is to add the total of capital and liabilities. So our capital is the total of 540 and 541, and then our liabilities is 551,000. 1,633,125. Yes, so I think we have satisfied the accounting equation that the assets is equal to capital plus liability. So our total assets were 163,3125. The same case to the total of capital and liabilities is 163,125. Make sure that you rewind this video as many times as possible so that you can get to understand. If you have a question, feel free to interact with me via the contact details provided. So until next time, it's goodbye for now. Thank you.